and welcome to the Trade Finance Distribution Initiative podcast, the business community shaping the future of trade finance. Thanks for being here with me, Doris Kononovich, and welcome to our summer edition. Let's start with a trivia question, shall we? Which asset management company has been helping customers achieve financial security since 1831, back when they were known as Scottish Equitable? If you guessed Aegon Asset Management, give yourself a well-deserved pat on the back. George Nijborg is their senior portfolio manager, and he joins us here today as our guest. George, great to have you here.
Thanks for having me.
Amazing. Thank you so much for being here, George. Let's start with a little bit of a background and introduction about yourself and as well your role within Aegon Asset Management.
Yeah, no problem. So I'm George Nijborg. I've been at Aegon Asset Management now for a couple of years. My background is in debt capital markets, syndicating both public and private transactions. I started my career at Morgan Stanley, moved to Citigroup, and then went on to Goldman Sachs. And then since then, I've been moving to the buy side, hence at Aegon Asset Management. And here I run the trade finance, insured credit, and private placement European teams. My background is very much across many of these asset classes that we are talking about, but maybe good to give an introduction on Aegon Asset Management, which is a 400 billion AUM asset manager. Across several pillars that we have are fixed income, real assets, equities, and multi-asset and solutions. We also have a large responsible investment team that plugs into all these different pillars that I just referred to. And then within the fixed income universe that we have at Aegon, there is the alternative fixed income and private debt team, which has around 60 billion euros of AUM globally. And that has several types of strategies, including mortgages, ABS, government guaranteed, corporate private placements, SME lending, insured credits, and last but not least, trade finance.
Amazing. And on the trade finance side, why is Aegon Asset Management active within this space?
So we've been active for many decades within the private debt world, also specifically in relation to export credit financings. Over the last years, we've been looking to expand our private debt capabilities. And one of the topics that came about was how do we offer a short-dated product to our clients, which has an attractive risk-return profile. And we came out at trade finance as a potential asset class. So we've been doing a lot of lead-up work in terms of launching this particular strategy. What we liked in terms of the asset class was multiple things. So I'll start maybe with the more economic reasons why we found the asset class attractive. So of course, the first thing that we look at, does this asset class offer some sort of yield pickup towards other similar short-dated asset classes in the fixed income universe? And the answer to that was yes, very much so. We also think this product can offer an alternative to cash, money markets, and short-dated credit for our investors. And last but not least, we think that in a rising rate environment, it can be a potential interesting tool for investors to use as a place to park their cash. In terms of the assets themselves, we like the fact that they are self-liquidating and have a short maturity. They also have a proven low historical default rate and a low correlation versus more traditional debt markets. And specifically from an insurance client perspective, we think that the asset class offers a Solvency II capital efficient lending opportunity. And then finally, from a structural perspective, we see that we are able to provide a lot of input as to how deals are structured. And therefore, we are able to put things together in a way where we are providing the best risk returns, we believe, for our clients. So we like the multiple layers of transaction credit enhancement features we can incorporate, such as the use of an insurance policy, for example, or in relation to the structure of the transaction, having covenants and similar features that make it attractive.
Now, you've said this yourself, trade finance is traditionally a space where you'd find, more of the banks and the credit insurance. What has changed, would you say, in the market to kind of attract new liquidity providers such as yourselves?
Yeah, the change has been ongoing for multiple years. So banks have had several headwinds, including change in regulation. So when we talk about that, it's in relation to Basel III and changes that are happening under Basel IV. Banks have also become a little bit more constrained in terms of what they can do from a technological and an administrative perspective. There are also administrative and operational costs that bank needs to take into account, in addition to the regulatory inputs that I just mentioned before. And all these things put together means that banks have had to be a little bit more selective in terms of the sub-asset classes within trade finance that they should focus on, and also in terms of the jurisdictions that they should be able to work in. As a result of all this, there is something called the trade finance gap, which is a very well documented feature within the world of trade finance. And the Asian Development Bank has stated that around $1.7 trillion of trade finance assets are currently not being funded in at all or in the way they should be. And it's specifically focused around SME corporates. So this altogether provides a potential opportunity for institutional investors. But there's been another thing which has been quite important to be able to fill this gap, which is the technological advances that have been happening over the last years. Because of this segment that we're talking about in relation to, for example, SME corporates, it tends to be more granular pools of, for example, receivables that need to be financed. And as such, it's important to be able to screen those debtors and sellers involved, analyze the portfolio of assets that are being financed, but also from an operational standpoint, being able to purchase and service those assets. And therefore, the improvements in technology overall have played a very important role in order to institutional investors actually be able to finance this segment of the market.
And where do your interests lie in terms of the originators? Who you looking to work with?
I would say, generally speaking, we're quite open-minded in terms of the originators we would like to speak to, as long as they go through our screening process in the right way. So that means, we are speaking to banks, factoring companies, tech platforms, or generally non-bank originators. So that's effectively the whole lot out there. And then once we are approached by them or we approach them, then we go through some sort of a screening process. First, we look at more economic parameters, such as the relative value of the product that they are offering us. We also look at, importantly, the scale of the opportunity they can offer us. Institutional investors are, looking for alternative investments which can not only offer that relative value, but also can offer them the right size for them to actually participate in a particular asset class, especially if it's a new one. Once that has been established, then we go through an extensive due diligence process on that originator. So that is many of the inputs that we look at and we do screening on. And then in terms of the relationship that we have with the originator, I think there's two main areas that we consider. One is transparency. So we like to have a lot of dialogue and access to staff, the originator systems, their policies, their transactional documents. And that's not only at the start of the relationship, but throughout the relationship that we have together. And then the second element is around engagement, particularly around ESG. So we have certain expectations with regards to ESG. Our clients have certain minimum requirements with regards to ESG, and therefore it's important for us to have the right engagement with our originators, so that in terms of them sourcing assets for us and for our clients, it's done in a way which complies with those requirements and standards.
Makes sense. And I was going to ask you just off the cuff, like, there's a whole big buzz around ESG. Why is that? You're currently in the market.
Well, I guess there's the positive buzz and negative buzz. The positive side is, people have been more aware in terms of what they finance. Is this the right thing to do? And therefore look at ways to be able to screen the investments that they are potentially investing in, and look at it from that standpoint. The negative side of all this has been, and I'm sure you've seen it all in the news, is around greenwashing, of course. So it is important to get that right balance between the standards you're setting on ESG and perhaps the product that you're selling to your clients. So that's one reason in particular, let's say, that we make sure when we look at transactions and when we set up a strategy that we have our responsible investment team also work with us in making sure that it's done in the right way in compliance with what the regulators would expect of us.
This is the Trade Finance Distribution Initiative podcast, and I've been chatting to George Nijborg. He's the Senior Portfolio Manager at Aegon Asset Management. Now, let's talk about some trade instruments. You've got traditional trade, SCFs, receivables, dynamic discounting. What kind of instruments are you wishing to fund?
Yeah, so I guess there's two answers to that: what we are currently doing and what we like to do in the future. Perhaps to start off with, what we are doing at the moment is effectively financing pools of insured receivables. We like to, like I mentioned before, have a lot of input in terms of how deals are structured. So we try and embed different credit enhancement features to make it as a best risk reward profile as possible within a transaction. Overall, of course, we look at ways in which we can balance that risk reward, and we look at ways in which a product can effectively eliminate or significantly reduce the inherent risks of this asset class. So, from a credit standpoint, we can look at defaults and insolvencies. How do we manage those? How do we reduce the risks of those? And then, for example, on the non-credit related side, we look at frauds and dilutions and other elements similar to that, and we look at how we structure the whole deal to be able to minimize those risks. So there's very many ways you can look at it and provide solutions to that, including, for example, diversification on the debtors, on the sellers, on the insurers that are involved as well, and of course on the originators that offer you the product. And then from a structural standpoint, when we talk about credit enhancement features, it's really around use of insurance policies, over collateralization of the pool, having covenants within a transaction, and having some sort of security as well. So that's how we look at things at the moment. The process, how we analyze trades, won't change much in the future. However, we will look at expanding our offering beyond the insured receivables in the future as well.
And looking at these processes, I mean, they do look straightforward, but we know that on the day to day, getting through that cycle and that workflow sometimes comes with its own unique challenges. What would you say are the business challenges when dealing with originators?
Yeah, indeed. Well, the first step is getting in touch with the right originators. So having the right network to be able to get in touch with those is important. Once we've decided that we want to work with a particular platform, so to speak, then there is the costs involved in onboarding that platform. And I'm not necessarily talking about monetary costs. It's the time spent in onboarding those platforms, which can take a long period of time. But it's definitely worth it once you've found the right partners, of course. And then there's the topic around standardization of transaction data. So, of course, different originators or different sellers have different ways of presenting their data, which sometimes make it difficult to have a like-for-like analysis. So, perhaps a more standardization of that transaction data would benefit all participants involved. I also think that there is work to be done in terms of the standardization of transaction documentation. There's a lot of input that gets done for every type of financing in relation to those transaction documents. So perhaps having more market standard features as a whole across the industry would smoothen that process quite a lot. Away from that, if you look at the originators, if we split it up into two broad groups, I would say the non-bank originators, perhaps there, in a lot of situations, scalability is a problem or an obstacle. We like to have a specific scale, volumes to be able to work with originators, which means that unfortunately some smaller players drop off for that particular reason. And when you look at, when you consider banks, perhaps there are two obstacles in terms of working with them. I think the first one is around relative value. So banks finance trade finance assets not only from a relative value perspective, but also for reasons beyond that, relationship driven perhaps, and therefore there can be that dislocation between the yield or the spread that a bank is offering versus what an investor would expect. So that bridge potentially needs to be transversed to be able to get to that middle ground between both sides. And then finally, I would say if you look at a bank, there's two models there. There's the originate to distribute model, and that works fine. That's great. We can source assets from those partners. But some banks, are very large in trade finance, but they don't have that model. So they just keep those assets for themselves. And of course, that restricts us from sourcing those same assets potentially.
And let's talk about a bit of funding now. Are you relying on credit insurance yourself?
Yes, we are, and it's something that we find, as I mentioned before, and I've highlighted several times, as a nice credit enhancement feature within our transactions. So we have a lot of dialogue with not only the originators, but also insurance brokers. We have good relationships with insurers. We like for them to know who we are and what we think and the type of products that we're doing, so that when they see these deal flows come through via our originators, then they think, okay, yes, we know this funder, we trust them, we know what they're doing, and therefore we're happy to insure them. We also have two people that are based in London who have an insurance background, and we value that also, not from a relationship standpoint in terms of what I just mentioned, but also being able to analyze the more specific complexities around using an insurance policy. And therefore, we place a lot of effort and time in analyzing insurance policies, getting those up to the standards that we need to be able to satisfy our clients' mandates. So in terms of what we look at, it's many things, but perhaps I can give you some ideas of the items that we look at, including, for one thing, the insurable interest. Is the SPV compartment, for example, or the funder themselves, the owner of the receivables, and are they the insured or co-insured party on the policy? Secondly, we need to make sure that the policy itself offers adequate insurance coverage via a policy limit, for example. Thirdly, there's the concept around exclusions and notification requirements. We need to make sure that these are market standard. We need to make sure that those are in the direct control of the insured and or the supplier. And we also need to make sure that these exclusions and notifications requirements match what is in the policy with what is in the underlying transaction documentation. So those are 3 points. Fourthly, we look at condition precedent and termination events to make sure that those are clearly stated, and we analyze what the consequences are for the coverage of the receivables pool that we look at. And lastly, is the claims timeline process to make sure that it's, for example, not open-ended, and it's clear what documentation would need to be provided in case of a claim situation. So these are several things, but just to give you an idea how specific the analysis of an insurance policy can be. And we believe strongly that you have to have the right expertise to be able to make use of that insurance policy in the right way.
And I must say, it's an indeed very thorough process as well. You must be very proud of the team. Well, I'm afraid this is where we call it a day on our episode today, George. Thank you so much for being our guest here today on the TFDI podcast.
Yeah, and thank you very much for having me.
And this is the part where I ask you out there to subscribe to our channel on Spotify. That's the Trade Finance Distribution Initiative podcast, and to our YouTube page, where you can watch this and all other previous episodes as a vodcast. Thanks for sticking around. I'm Doris Kononowicz. See you next time.